What's up, guys? I'm nobody special, and I'm very happy today because here in my very home, I have my fellow doomer, Melody Wright. Melody, welcome, and how are you doing today?
I'm doing great, Jack. Thank you so much for having me and hosting me.
Thank you. It was my pleasure. I found out you were heading up to New York for a conference, and I said, well, why don't you stop by on your way up here? We hung out last night. We had a good time. We were talking about mortgage delinquency and Black Knight, and of course, it was too late to start filming.
Yes.
And we probably gave away all the best content while the camera wasn't rolling and nobody was listening. So we're going to try to recreate that conversation we had last night now that the camera's rolling. So I'm going to start. Let me cue you up. We had some delinquency data that just came out recently. We were talking about this on our other project, Doomers News Network, shameless self-promotion, link down in the description. Delinquency data. If I go to the St. Louis Fred website, which is where most people get their economic data from, and I go look up residential mortgage delinquencies, all commercial banks, all I see is 1.71% delinquency, right, which is coincidentally very similar to what we had in the third quarter of 2006, hint, hint. But to anybody looking at that chart, delinquency is not a problem.
Right.
So what makes you say otherwise?
Yeah, well, so firstly, things have really changed since the GFC. So the banks used to be the primary lenders, but since those, the Basel III standards that came out after the GFC, trying to, shore up capital at the banks, it risk-weighted mortgage assets very heavily. And so the banks no longer wanted to hold these assets and essentially transferred a lot of their existing mortgage servicing rights. And let me explain that because it's kind of confusing. In our hyper-financialized world, people will essentially buy the servicing strip of an asset, which is the right to take the payment. And then that gets valued into a mortgage servicing right, and that sits on the balance sheet. So what the big banks did is they sold off a lot of those MSRs, as we call them, to non-banks. And now non-banks they do the majority of lending. And so if you want to get a sense of what's happening in the mortgage market, you cannot use just the Fred Commercial Bank series because it's just tracking the banks.
So if I could pause you real quick, there was some mortgage industry terms a lot of people maybe not familiar with.
Sorry.
Mortgage servicing rights. The plumbing, the pipes that the money flows back and forth between we, the mortgage payers, and the banks. Is that accurate to say
That's
what
correct,
that is?
yes.
Okay, and that one little caveat on the St. Louis Fred that says all commercial banks on that chart, it sounds like, well, this is all the data, but most of the mortgages don't live at commercial banks anymore. They live with these, what would you call them, MSR servicers?
Or non-banks. Non-banks originators are servicers.
Okay, so the delinquencies, even though all commercial banks is showing 1.71%, that's kind of an irrelevant data point then, isn't it? Because most of the delinquencies live somewhere else.
Correct.
And what is that data telling us?
Okay, so you have to go a whole bunch of different places. There's an industry publication called Inside Mortgage Finance. And they will list out delinquency by servicer, these entities. So if you look at someone like Chase, B of A, they're tracking right along that Fred schedule, around that 1.7% lower delinquencies. And again, they're not doing as much as some of the risky government lending, Jack, because it is all government lending that these non-banks do. So I don't want the viewers to think, hey, non-banks, that sounds like the previous crisis. Really what happened is now almost materially, 85% of mortgage outstanding is government sponsored in some way or another.
Fannie and Freddie.
Fannie, Freddie, Ginnie Mae, FHA, VA. So if you're looking at that commercial bank schedule, you're not going to know anything. So Inside Mortgage Finance will list servicers and say, here's your delinquency. Now, they don't list all, because if you don't want, like, let's say I'm United Wholesale and I don't want anyone to know my delinquency, I'm not included in that schedule, even though I'm included in their overall survey. But you can look on that list and you can see the specialty servicers, and what those are, they handle default. They're just really good at it. I mean, default is hugely expensive. I can tell you, it's not a wonderful life. Nobody wants to take your home. It is so expensive to do it because of all these government regulations. You have timelines that you have to do every single thing on. If you miss it, and these servicers, they suffer from abysmal technology that was built in the late 60s, 70s that you can't really change. So, looking at that specialty servicer delinquency, you could see much higher delinquency. Someone like Specialized Loan Servicing had around a 7% delinquency. Then you look at someone like FCI Lender Services, they do the private note space, which we've talked a little bit about. They also do default servicing. They were at 32%.
Whoa.
The other thing about that FRED schedule is it only gets updated quarterly. So, what we recently saw in mortgage delinquency is going to show up there, but it's not going to be the full picture because of the government loans, et cetera. So go ahead.
So the all that's pretty wild. The all commercial banks data, which creates the impression that this is everything, 1.71%. Now the other one, what did you say? Specialty servicing.
Specialized loan servicing.
Specialized loan servicing, 7%, and then private notes, which are all the rage now. I hear so much about private debt and private credit. 32% delinquency rate. So that 1.71%, oh, the delinquencies are so low that all the bulls love to throw around, it's nowhere near accurate, is it?
That's correct.
Now, talk to me about the trend. Where that number's already higher than they're telling us. Where is it heading, and what's it doing?
So the trend is just, I'm still kind of in shock. Overall delinquency increased month over month, 13%. You just don't see moves like this in mortgage very often. And 30 plus delinquency increased over 19%, which is absolute insanity. And that is the delinquency you care. Everybody talks about seriously delinquent loans. That's not the story. It's the early delinquency, because that tells you about the health of the consumer at that point in time, right? And so seeing moves like this, we haven't seen since May of 2020, basically.
Wow.
And a period that you could compare it to of when we were trucking along after Q3 2006 is August of 2007. You saw a huge jump in 30 plus delinquency between August and September. This feels very similar in some ways to that moment.
So a 13% increase in overall delinquency, but more important, a 19% increase in 30 days. And 30 day is important. That's the threshold where people's credit gets dinged. So if somebody's going to let their mortgage go 30 days late, there's a really good chance they're going to go 60 also.
That's
and
correct.
90, right? Because that's the big cutoff.
Right.
And of course, nobody instantly goes 90 days late on their mortgage. You have to go 30 and 60 first. So this is a preview of higher serious delinquencies on the horizon. And you're saying comparable moves, August 2007, May of 2020, seriously bad times to be in mortgage finance. So even though we have that chart showing 1.7%, clearly we're in a much more dire strait than it comes to, sorry, I always play dire straits down here at my bar, so I just have dire straits on the brain. I've got Sultans of Swing playing in my head as we're talking about this. So seriously delinquent, a dire situation in mortgage finance, and it's getting worse. Now, one of the key players in these mortgage servicing rights, and one of the reasons why that St. Louis Fred data is so incomplete, has to deal with this company, Black Knight.
Yes.
And we were talking about the history of Black Knight, and this is where I need you guys to get your tinfoil hats ready, because the more Melody and I looked into this company and the people and the history of the company, it really paints a picture of, that George Carlin line, it's a great big club and we ain't in it.
We ain't invited, Jack.
So let's talk about Black Knight.
Sure.
What can you tell me about them? Real high level stuff, and then we'll nail down the specifics.
So firstly, let me tell you how they manage this message. I want to mention that. They essentially said in their press release, calendar-driven delinquency, as if the calendar itself drove the delinquency. And they put a little line in there that said, typically when months end on a Sunday, you can see temporary spikes in delinquency.
Oh, don't worry. There was one less Sunday, and there were one more Sunday. It's really all very complex. Disregard that data. Nothing wrong. Nothing to see here. Move along. Is that the message?
That's the message. Servicers effective date those checks. They don't want that default timeline to start either. That means a whole bunch of more work for them. So they're going to effective date that check, because at 36 days of delinquency, that's when all the calling starts, all the notices. So it's a lot of expense. So they managed the message saying that, and I looked back at March, because March also ended on a Sunday. Also, you had Good Friday, right in that, a holiday, just like you had 4th of July, right? And delinquency went down month over month. And so are they just inept? I don't know.
So they're telling us this. Sorry, again, I want to back us up. They're telling us this 19% surge in delinquencies. Don't worry, it was just this flop of the calendar because Sunday.
Right.
But then that happened in March, and there was a holiday in that month too. The same calendar situation was in March, and delinquency went down. So this whole talking point that don't worry, the delinquency's calendar driven, they're blowing smoke.
They're blowing smoke, and the way I know that is I also still oversee client books, and so I saw their delinquency, which was higher, believe it or not, and it didn't cure. So I could go back and look. Okay, did a bunch of checks come in at the beginning of the month, and they effective dated and cured the delinquency? That's not what happened. So you're going to have in delinquency a push and pull, because the minute you are that 30 days delinquent, like I said, you're going to get calls. Do you want a repayment plan? Do you want a non-COVID forbearance? Do you want a modification? They are going to get in early, because that's what the agencies tell you to do, Fannie, Freddie, and they will do these things called compensatory fees if you don't do this all on that timeline. They'll like review and audit, and you'll be penalized. So they're going to try to get someone performing as quickly as possible.
Okay. So they're fudging the numbers, it sounds like. They're disregarding an alarming trend in delinquencies. Now, let's talk a little bit about Black Knight and where they come from.
Sure.
I'm going to take you through the timeline that I found on this company. And there's going to be a lot of names of companies people have never heard of, because these companies don't get publicized very much. It's a very shadowy sector of the financial system. Even though we're talking about mortgages, the single largest expense and line item in the average family's budget, whether it's mortgage or rent if you're a renter, everybody touches these guys, and we know nothing about them.
Right.
All right, so Black Knight, their history starts in the year 1962 as a company called Computing Statistics Services. And for 30 years, nothing happens. They're a financial data company. But in 1992, they get bought out by a company called Alltel Computing. And it's shortly after being bought out by Alltel that things start to get interesting for these guys. In 2003, Fidelity buys Alltel. All right, so now we're Fidelity National Financial, FNF. This is one of the big finance companies. Most people have heard of Fidelity. So they buy Alltel. And then 3 years later, for whatever reason, in 2006, Fidelity spins off Fidelity Information Services, or FIS, which includes Alltel, which includes the company that would eventually become Black Knight. So now we've got this new company, FIS, a spinoff of Fidelity. In 2008, this spinoff company, FIS, they spin off another piece of themselves and become LPS. Now, who is LPS?
It's lender processing services. They just the back end technology of the servicing world. And so, again, very old technology, blue and black screens. Today, you can walk into banks like PNC and see blue and black screens. Not kidding you.
The old MS-DOS
Correct.
command prompt.
They have no UI, user interface. They sometimes will do a little user interface overlay, but it's all very manual, no security. So if you're in the call center and you need to put a hold on something so you don't call them, maybe they're in bankruptcy, someone else in the company can come just take that hold right off. So you are constantly monitoring exception reporting. Anyway, I could go on forever. It's poor technology, LPS, and they also were in default management, default technology. And if you don't mind, I'll share how they got in trouble.
We'll get to the trouble point. Yep.
Sorry.
Well, actually, no, because, okay, that's good. Fidelity spins off LPS in 2008. Now, 2008, that's a year that's probably bringing up some alarm bells in people's mind. So conveniently, Fidelity spins off the company, and then the company spins off another piece of the company right as the GFC hits. And then 2011,
boom.
They messed up. They got in trouble. What happened in 2011 with LPS?
So when they spun off, they also did back-end operations for big, large servicers, their document processing. And so like the other big mortgage servicers, including mine, they were robo-signing documents. And so what I mean by that is when you have to, in a judicial state for foreclosure, you have to file what's called an affidavit of due and owing. And that's where all the figures, how much you owe, is in there. But anytime you sign an affidavit, you're supposed to have personal knowledge of what's in that document.
Got to know what you're doing.
Exactly.
You got to parse the data, make sure it's accurate, and then sign your reputation that this is a truthful, factual statement. I mean, this affects people's lives, right? Their homes, their foreclosure, and everything. Okay.
And so they were doing things just quickly, like signing the documents, but they were also forging notaries and things like that. So notaries. So people would say, maybe sign a pile of like 50 affidavits. They'd take them to the notary room, and the notary would just sign there. So all kinds of things. And in some states, you don't have to have that's all very confusing. But they just were taking a lot of shortcuts in this legal process that is foreclosure.
Okay, so if I could summarize all that, it sounds like what they were doing was basically rubber stamping foreclosure documents illegally, robo-signing. I heard things like forging notaries, that walks like a fraud and quacks like a fraud a little bit there. So they get slapped with a consent order from the Financial Review Board? The FRB?
No, the Fed, the Federal Reserve.
Federal Reserve.
And the FDIC, OCC. Mm-hmm.
Okay, so they get hit with basically regulatory action saying you can't do that.
That's right.
That's 2011 after the GFC. So now 2014 rolls around, and Fidelity goes ahead and they buy back LPS. And this is what's kind of crazy to me, because we had this whole financial crisis thing. Right before the financial crisis starts, Fidelity spins off the company that would become LPS. They let the crisis happen. Now the crisis is over. They get in trouble with the regulators, and then Fidelity says, we changed our mind, we're going to buy them back. It's almost like they spun them off just to let all the bad juju out, and then now, come on, welcome back to the family.
That never happened back then, Jack.
Yeah, that kind of thing would never happen. Okay. So now they're back with Fidelity in 2014. And in 2017, Fidelity says, you know what, we've had enough with this whole thing. They spin them off again, and now the company becomes named Black Knight. So now we've actually, for the first time, heard the name Black Knight in 2017 after, it's been almost 40 years now, and being bought and spun off and bought back by Fidelity. Sorry. So now we're going to fast forward. Now Black Knight is officially a standalone entity. Fast forward to 2022, and Black Knight gets bought out by Intercontinental Exchange, or ICE, parent company of the New York Stock Exchange.
Yes.
So now this is getting juicy now.
Big boys.
And somehow this gets through regulatory approvals, and somehow this is not a monopoly for the company that owns the New York Stock Exchange to own all of the mortgage plumbing in the country. Somehow this mortgage happens. So tell me about this merger. What do we have now?
Well, so just talking a little bit about when they bought Ellie Mae, because I want to talk about the way that this actor acts in the industry. They are very big tech-like. They essentially own your data. So you use their system, and most people in the industry use that system because it's got the built-in compliance from Dodd-Frank, essentially the timing of how you had to do things. And people are just were so afraid of being non-compliant, they wouldn't want to go buy another origination software. Now, here's the bad part. Essentially, you use that software, and you almost have to use that software. There really isn't any other competition, but you don't own the data that you put in it. So all of that information that we get from borrowers, their financial information, their credit reports that list every single account that they have, all of this, I would say healthcare has as much data as mortgage, and really they don't have your financial data. So all of that data that we would enter into this technology, essentially the companies themselves did not own. Ellie Mae or Encompass owned. And so when ICE comes along and buys them, they now own this data. And then they also went into, on the servicing side with Black Knight, and that's where that big merger came in. And the FTC threw up its hand and said, I don't think so at first, but ultimately they let the sale go through.
So the sale ultimately goes through. Now ICE owns Black Knight. So the same company owns the New York Stock Exchange. They own all the mortgage plumbing. They own basically the collective financial data of every American. Somehow this gets through regulatory hurdles. Now, let's talk about some of the people behind Black Knight at ICE. CEO Jeffrey Sprecher, seems like an interesting character. First of all, Jeffrey Sprecher's wife She's got an interesting history. She's actually some political connections. Unusual to see powerful financial elites with political connections, isn't it? What's going on over there?
Well, so she was appointed in Georgia as a senator from 20 to 21. They're long enough, though, to get the memo about lockdowns. So the senators got a pre-memo outlining what actions were going to be taken, like the lockdowns. And so, like all of our good politicians, when they got that memo, they went out and then bought some stocks.
Yeah, what do? Do we warn our constituents? Do we prepare the country for what's coming? Heck no. Let's start trading that thing.
Yeah,
That's what they did.
So they got in a little trouble, or it seemed like they were going to get in trouble. This couple brought up in front of the ethics board, etc. But that was conveniently dropped. I mean, Nancy Pelosi probably wasn't really going to go enforce that kind of.
Yeah, Nancy, another fantastic trader. So this is 2020. They get out of a classified briefing on the vid. They leave that briefing. They go and they make insider trades, which should be illegal. It's a whole other thing. They get caught doing it. So she's basically disgraced. Lori Loeffler, was that her name? Or
Kathy Loeffler, I think.
Loeffler or Loeffler was her name. She was a senator for a year. She was appointed because the senator who had won election had been retired for health reasons. I think Warnock is now in that seat. She gets appointed. Why? Because, I don't know, because her husband owns everything, I guess. That probably helps. While she's there, she trades on insider information. And yet 2 years after this, after she does this insider trading scandal, her husband's company is allowed to buy the biggest mortgage servicing and originating company in the country. So despite the history of financial malpractice, I don't know any other way to put it, somehow this merger gets cleared.
Yes, and that is so. On the face of it, what Black Knight did is they had a little origination system. They had to sell that off, and that's how the merger. But honestly, ICE owning both Ellie Mae and Black Knight is essentially like American Airlines coming in and buying all, Southwest, JetBlue, all these smaller operators.
So you've got basically a mortgage monopoly that overlaps with close to a stocks monopoly with owning the New York Stock Exchange. The CEO's wife used to be a United States senator who had a scandal for trading on insider classified information. Doesn't matter. He's allowed to buy up this company. Also, some interesting things we found out about this guy, Jeffrey Sprecher. The Intercontinental Exchange, or ICE, this company was founded as a natural gas and emissions trading firm, which if you guys have been following my channel, you know I've done a little bit of research into some natural gas and emissions traders recently. A little company called CoreWeave, which is owned by guys who used to run a company called NatSource LLC, the biggest traders in carbon credits in the United States. And lo and behold, ICE CEO Jeffrey Sprecher just happened to sit on all of these government, regulatory, and climate change boards with Jack Hogan, who sits on the board of directors at CoreWeave and the former boss of CoreWeave's CEO and chief technology officer. It is amazing, this club. Yeah. It's not even a big club. It's a small club, and we ain't in it.
That's right.
And of course, now the pioneers of artificial intelligence have shifted from emissions trading and natural gas to mortgage and stock monopolies and
crypto. Don't forget.
Oh yeah, crypto.
ICE has a little crypto futures trading organization as well.
Yeah, there's definitely no wrongdoing happening in crypto futures trading. It's all very above board.
All above board, correct.
Well, Melody, this has been a very interesting trip down the rabbit hole, this conversation about Black Knight and where they came from in the history and just the mind-blowing level of corruption involving government and financial elites. And what blew my mind about it is I'm sure most of the people watching this have probably never even heard of any of these names like ICE, like Black Knight.
Right.
Unless you work in the financial services industry, you never hear about these guys.
Right.
And they touch everything.
They are the plumbing.
Yep. Well, Melody, I want to thank you so much for your time and sharing this information. Also, thank you for working with me and Travis on our new project, Doomers News Network, of course, my fellow Doomer here. Thank you for coming and for taking the chicken coop tour with my daughters yesterday. Melody is considering getting chickens, and so my daughter had a blast giving you a tour of the chicken coop yesterday. That was very sweet. Thank you for doing that. She just loves to talk about those birds.
Well, Thank you for having me. And that tour was the highlight, Jack. I mean, I've had a great time, but that is quite an impressive operation you have going on back there. It's awesome.
You got to meet Squeaky, my overly territorial
He was
rooster.
a little scary.
Yeah, Squeaky. Me and Squeaky are not always on the same page or in the same book.
He's a little terrifying.
Yeah. All right, folks, that's Melody Wright. I'm going to put a link to her YouTube channel down below, along with a link to DNN. I highly recommend you follow both of those. Thanks again, Melody. And everybody, until next time, live small and dream big.